Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. And thank you for allowing us to do work that we find meaningful. Thank you for giving us the most valuable commodity you have, your attention. We promise to do our very best to give you a return on it. Today we have Brien Lundin, host of the New Orleans Investment Conference and chief editor of the Gold newsletter. Brien, thank you for coming back on the show.
Great to be with you, Steve. Thanks for the invitation.
Yes, pleasure's all on this side of the table, sir. I'm really excited. We've got the New Orleans Investment Conference coming up. This will be the 50th anniversary, November 20th through 23rd. Go ahead and give us a rundown, and what can attendees expect this year at the conference?
Well, this is the longest running investment event in the world today. This is our 50th anniversary, and every year we try to pull out all the stops and outdo ourselves. But this year's really special. It's special for a number of reasons. It is our 50th anniversary. We have an incredible lineup of speakers. I encourage everyone to go to our website, neworleansconference.com, to look at our speakers like, James Grant and Danielle DiMartino Booth and Dave Collum, George Gammon, Rick Rule, Jim Bianco, Jim Iorio. The list goes on and on. We have dozens of the top speakers around today, and dozens of what I believe are the top thinkers around today. But it's also really a big year for other reasons, and primarily because we're in the early stages of a metals and mining bull market. And if there's one sure thing in investing, it's that you want to be at the New Orleans conference at the beginning of a metals and mining bull market. So this one's a bit unusual, and I know we're going to get into this in a bit, but unlike other metals and mining bull markets, the metals have already taken off. They're already in a confirmed secular bull market, but the mining stocks have yet to make their big move. So that's a really, I call it a generational opportunity right now, staring us in the face. And we are going to have the top experts in the sector to give you their best picks, but we're also going to have a number of the top companies, dozens of the top companies in our exhibit hall for you to meet and discover their stories.
Yeah, I'm really excited. This will be my first conference out there. The missus and I will be running around with our camera and microphones and interviewing as many people as humanly possible.
Yeah.
So I'm really excited.
You'll love it. You'll love it. There literally is nothing else like it, and it has to be experienced to believe. You have a lot of exceptionally smart people, really giving people who love to share their advice. You get as much value from the other attendees as you get from our main stage, which is saying a lot, because you get a lot of value from our main stage. We really focus on delivering top quality content, and I feel like if I do that for my attendees, then everything flows from that.
Yeah, and if someone can't attend personally, physically, you guys also have a virtual event as well.
Yeah, we do have a virtual option. They just need to follow the links on our homepage for registration. They'll see the virtual option. We don't really promote it that much because the experience of being there in person is really extraordinary. So we really encourage people to be there in person, but we do have the virtual option. And either way, you'll get recordings, so you won't miss a thing, either in person or virtually. You'll get recordings, you'll get written transcripts, so you won't miss a thing. But the experience of being there is really something that we don't want people to miss if they possibly can make it in person.
Awesome. Okay. Well, there will be a link in the pinned comment below. I hope to see you guys there. And if you can't make it in person, then we'll see you virtually. All righty, Brien, let's start out like we always do. And what is your macro view of the world economy and financial markets today?
Yeah, the really big picture is that we are in the end game, I believe, of a 4-decade plus trend of ever easier money. And it's not only the fact that the central banks, led by the Fed, have been forced to continually lower rates and eventually come in with direct stimulus, post 2008. At every recession, every hiccup in the economy, the response has always been to make money easier and to come in and rescue the economy and the markets, rather than let them wring out those excesses. So you have that trend, but also the process of ever easier money, ever lower interest rates has encouraged ever greater debt accumulation. So those trends are intersecting right now, where the markets cannot endure higher rates, not only because they have been addicted to ever easier money, but because the burden of servicing these monumental debts at anything approaching normal interest rates, really anything above the rate of inflation, is something that is unendurable by the markets. You simply cannot have interest rates above the rate of inflation now. So that means we will have negative real rates going forward as long as this current monetary regime is in place. That argues for investing in obviously the monetary metals like gold and silver, but also commodities in general, things like real estate, tangible investments. And it's a different world going forward now.
Yeah. Okay, so ever easier money policy. I'm going to pull up a chart here that I think will visually show that
Mm-hmm.
here in a sec. One thing you mentioned, negative real rates. I've got a small part of the portfolio into bonds right now,
Yeah.
and I feel like no one's talking about bond vigilantes, and that's kind of my hesitation with
Mhm.
that bet. Is that what if they just stop showing up to the auction?
Yeah. Well, we had, and it's interesting you bring that up because there have been a couple of very brief episodes, but I think they were telling. Last fall, around October, November timeframe, if you look at, say, gold versus the 10-year Treasury yield or gold versus the dollar index, you'll see that there was a brief period where that correlation was positive. In other words, higher rates the gold price was rising, and stronger dollar, the gold price was rising. And in fact, even though we were starting to anticipate at that point the Fed pivot early in the year, it never happened, but the markets were about to price in 5 or 6 Fed rate cuts for this year. Despite all that, we saw Treasury yields rising. And that was an example of the bond vigilantes briefly sticking their heads out of their foxholes to say that there's some question about the debt accumulation right now. If you remember back then, we had just tremendous forecasts for deficit spending. We had the Biden administration really ramping up spending and fiscal efforts, et cetera, and the debt was exploding. The debt and the deficit was exploding. And yeah, so we had the correlation between gold and treasury yields and the dollar were all positive for a while. They were all rising in concert. That, I think, was a brief emergence of those bond vigilantes. And that's an analysis, a part of the analysis that people don't really think about that often. We think that, we'll have with easier money, we'll have falling treasury yields, we'll have a rising gold price, et cetera, and that the Fed is essentially in control of interest rates. They go wherever the Fed wants to pull the right levers, and they can drive interest rates wherever they want. But at some point, they can lose control. And the only way that they could regain control would be not just a heavy buyer of treasury securities like they are now, but the dominant buyer, like we would see in Japan, and that leads to long periods of economic underperformance. It can lead to other problems that the Fed absolutely loses control of the markets. It's a great uncertainty, and the end result, I think, is that like something I told some of the major financial media a few weeks ago. Gold is the all-weather investment right now. Whichever way things go, if you can see that gold will perform very well. If the Fed just continues to lower rates. We have a soft landing or no landing. Because the Fed is lowering rates, gold's going to do very well. Financial assets probably will as well. Stock market probably will. But if the Fed has to start lowering rates in a more of an urgent fashion because we go into recession and we have that hard landing, then gold's going to do extraordinarily well and outperform everything else, because at that point, the forecast will be for much lower rates and the Fed really getting into its rescue mode like we saw in 2008 and 2020. And I think gold's starting to kind of signal that right now. I think that's one of the big reasons why we're setting new records is portfolios around the world, smart money, is recognizing that gold is, I don't want to say can't lose because I don't want to jinx it, but it seems positioned to perform well, whatever the scenario is ahead. So they're just shifting allocations and increasing their gold holdings on the margins, and that's enough. That's enough to power the price ahead because it's such a small market, relatively small market.
Yeah, and I think I've been thinking about this a lot lately, just because we have the election coming up. But I kind of think no matter who wins, because neither candidate is talking
Right,
about
exactly.
solving the problem of cutting spending, they're
Mhm.
both going to cause inflation just in different ways. One's going to do it through taxing imports, and the other one's going to do it through price controls. But
Yeah.
kind of no matter who wins, gold should do well.
Yeah, I have a number of people asking me for my analysis of the election and how it will affect gold, and that's my point of view. Neither side is going to address the biggest issue out there right now, being debt and deficit spending, and it's never even been addressed in the debates and the party platforms anywhere. Nobody's talking about it at all. So they're both going to spend and continue to spend and exacerbate the problem. And we're in a debt spiral right now. We're borrowing money to pay the interest on the ever-growing interest on the federal debt. So we're adding to the debt just by our debt service payments. It is a debt spiral that even for the issuer of the world's reserve currency, I think at some point it matters.
Yeah, I call it putting it on our children's credit card.
Yeah.
I'm going to share my screen here, and I'll explain this chart here real quick. So this is the Huey, and
Hmm.
so the bar chart here is the Huey, and this purple line right here is the Fed funds rate. So this chart goes back to the 90s, and then this is 2000 and the Fed
Hmm.
cutting rates. And this pink line we see right here, this is the Fed's balance sheet, right?
Yeah.
And so when they started cutting rates here in 2000, the Huey just had an amazing run until they were done cutting rates. It moved up
Mhm.
300%, and then it just moved up another 71 after that. And then here in '07, they cut rates, and about halfway through the cycle, the Huey moved up 58%, but then proceeded to fall 70. And then we invented QE, and the Fed started printing, and we just had a monumental run here of over 300%. So
Yeah.
then we fast forward here to the COVID crash, and as they started cutting rates here, gold kind of led, and it moved up the Huey led and moved up another 35%. Then we had a 44% sell-off, which didn't last long at all, just a V-shaped recovery. And then here again, we can see the pink line. They started printing, doing QE, and it had 160%. So my
Yeah.
question is, we've just started cutting here. Do you see a similar pattern where we may have an initial run up and then a spike down like we did before of over 40%, and then in the previous one over 70, but then a monumental return? Or what do you see with this chart?
Yeah, it's very likely. That 2008 and 2020 downdrafts, those were, exogenous events. Those were market crashes in the stock market. Leveraged investments crashed, and gold served as it really performed its role. It served as the piggy bank that was broken into when investors and traders needed cash all of a sudden, primarily to meet margin calls. So those were liquidity vacuum type events. So if we have a very hard landing, some type of a crisis situation, we will have a few days. And that's literally how long those episodes lasted, a few days to a week, before gold quickly recovered as investors settled their margin calls and traders who still had the ability to trade recognized what the policy prescription was going to be, and that the Fed is going to come in and rescue the markets with an avalanche of liquidity. So yeah, we could have that again. It's very likely, but only the most nimble traders should plan on that. At some point, the values are there and need to be taken advantage of. And for the metals, the mining stocks are where you get those values right now, and where I think they need to be not just accumulated but bought at these levels. Now, for gold, I think given its price run, you want to look at gold itself, not so much as an investment, but as insurance, because you use gold at these price levels to lock in the exchange rate with the dollar or whatever your currency may be, in the full knowledge that over the next 3, 5, 10 years, your currency is going to purchase less. It's going to lose purchasing power over the years to come. But gold will preserve that purchasing power. So even at these record levels, buying it now locks in the purchasing power of your currency for whatever amount that you put into the metal. So it's really an insurance play right now. Silver, I think, has fairly explosive upside potential still, and silver-related junior mining stocks are offer leverage on top of silver's natural leverage to gold.
Okay. Yeah, so the Huey is going to be an exaggeration of this because they're mining stocks, so they're very leveraged to it. But when we look at the gold price, you don't have those massive corrections like you do in the stocks. The gold price itself is just a much smaller correction. Yeah, okay. So basically, if we have a liquidity crisis, we're probably going to see a repeat of that chart. If they actually happen to nail a soft landing or they keep the plane flying, that's not going to happen.
Right. And if we have that kind of a liquidity vacuum, that kind of a spike downward, jump in head first. It may take 2 days or so for the bottom to be reached. But when you see that kind of panicked selling in high quality mining stocks in particular, and the metals themselves, it's an opportunity that needs to be taken advantage of.
Okay, maybe like 2020 was with oil when it went negative.
Or 2020, as you know, for gold, silver, and mining stocks, I jumped in as everybody was selling and enjoyed tremendous gains over the next 6 months. It's not something I would wait for to buy, but if it does happen, I would scrape up every available cent and put it into the best names out there and the best bargains out there.
Okay, all right. So have a little cash on the sideline.
Mm-hmm.
All righty, we went over macro for gold. Listener questions. Marcia wants to know, you kind of touched on this, but maybe you
Yeah.
can expand a little bit. Would Brien buy gold at the current price if he didn't have any, or wait for a drop in prices?
Yeah, and I tell people there's 2 reasons to buy gold: insurance and investment. And the insurance aspect, if you don't have any, I advise you to have physical that is accessible, either in your house somewhere in a safe or someplace where you can get to it, not in a bank safe deposit box, because that's one of the things you're insuring against is a bank holiday. But have some physical metals accessible, have an allocation of your investment portfolio in the metals as insurance. And that's not an allocation so much of your investment portfolio, but an allocation of your wealth. something to put aside to preserve your wealth against this depreciation of currencies that lies ahead. And when you think that the macro picture argues for much higher gold prices, which I think it does right now, then you want to invest. And the way to invest right now, I think, is through mining stocks that show some leverage to the underlying metals.
Okay. All right. So basically, look at it as like a really long-term bet rather than trying to catch
Yeah.
little tick in the charts. Okay. Company questions.
Mhm.
Double A wants to know, what is your opinion of Empress royalty? They seem to have a lack of progress in closing deals.
Yeah, they do. They have not closed a lot of deals. That's one of the reasons why they are one of the less expensive of the royalty plays. But the reason why they're not closing deals is because they essentially build those deals from the ground up on a client basis with a team that from Endeavor Financial and that has a really deep bench. And I've gotten a bit of a peek into how deep that bench is and the level of due diligence that they do. And the deals, I don't know what they're working on, but I have confidence that whatever deals they do are going to be really good ones and ones that are highly secured. Uh, when they do a deal, they usually have security that other royalty companies don't have. In other words, they don't want to, but if needed, they could take the mine. So in some cases, at least. So I really like the team there. I think it's undervalued right now for the cash flow that it has ahead. And I have a lot of confidence that they're going to have more deals to come. I know they've got stuff in the pipeline. I have no idea what it is, but they've been very public that they're working on a number of potential deals. So I like where they are right now.
Okay. And Rafi wants to know about Erdene Resources, his opinion about the company and what kind of potential he sees from its new mine coming online in the middle of 2025.
Yeah, it's a great company and an extraordinary project. They are just finding gold wherever they look for it, and high grade gold. And they have a tremendous property position in Mongolia. They recognized that they needed to bring in a partner to fully exploit it. And they also recognize that the best partner may just be the largest construction and mining company in Mongolia that has very deep connections in the country. And they did that. They went into a 50-50 deal. Construction on their first mine is advancing. It will be the highest grade open pit mine in the world. I believe the average grade of this open pit is going to be about 3 grams per ton. And
Wow.
this is just a start. This is just a start. Production is going to come, I think it's the first quarter of next year. So even if you say the second quarter, they are on the doorstep of very high grade, very profitable production. My fear with Erdene is really just the degree of the upside, in that I want them to be able to hold off their local partner for as long as they can. I want to see that cash flow come in to prove, to establish the kind of market metrics for the value of this company before they get a takeout offer by their partner. And hopefully they have the power to resist that, because that is the natural buyout partner for them. But they are going to spin out production numbers in the near future that are going to be just mind-boggling. I should say I own the stock. I also personally own Empress. Uh, but their property position as well has tremendous upside potential. So they are still drilling, but once they get this cash flow, they are going to attack that huge property position, I think, very aggressively and turn out more high-grade numbers that could be, you know, really shake up the market. So I love the play right now. I think they're in a great place. I think it's one that's going to take maybe a year to 18 months to fully realize its value. but they're in a great spot right now.
Yeah, and at the early stages of a gold bull market, that could be quite a arbitrage catch there.
Yeah, quite a combination.
Yeah, yeah. So 3 grams per ton. What's the average? Like 0.9 or 1?
No, that is the average.
No, no, no. I'm saying what's the worldwide
Oh,
average?
the worldwide average for open pit is under 1 gram per ton. Yeah, probably between around 0.8 to 1. You can make good money in like Nevada, around a half a gram per ton on an open pit, but worldwide it's generally about 0.8 to 1 gram per ton.
Wow. Okay. Interesting. All right. Patrick wants to know about the junior royalty space. Is there a need for further consolidation for juniors to have enough opportunity?
Yeah, the royalty companies in the junior space sprouted up over the past, I don't know, 5 to 8 years or so, kind of like mushrooms after a rainstorm. They're all over the place now, and the problem is that the latecomers have to bid with the rest of them for any new royalties that come onto the market. And that means that the prices of those royalties are going to rise and the returns of them are going to be lower. So you need to focus on companies that have some differentiating aspect. We've done that in our portfolio, primarily of Metallo, because it was one of the first or the first. We have Horizon Copper, which is a great little niche in obviously copper, and a great team behind them in Sandstorm Gold. And we like Empress because they find and build those royalties with great security from the ground up. So you need something that has a differentiating factor to it. Primarily, and most importantly, you want a royalty company that has near-term cash flow or cash flow. Some of the royalties that I see being acquired by companies right now or of projects that may or may not ever come to fruition. And if they do, they may be, 10 years down the road. So it's important to find quality. And I think that broadly speaking, with some notable exceptions, the cream has been taken off the top of the royalty market. There's not as many really high-powered royalties out there to be acquired.
Okay. All right. Um, let's move on to silver. What is your macro view of the silver market today?
Yeah, it's the same. It's for gold. And, I tell people if you like gold, and you should, then you should love silver because it provides natural leverage to gold. In every long-standing bull market for gold, which means a bull market that's based on monetary issues, monetary concerns, not geopolitics, but underlying basic fundamentals like the more rapid depreciation of global currencies. If you have that kind of a bull market, then silver has always outperformed gold, and I think it will again. That's precisely where we are, and silver is just starting as we speak in recent days, really show leverage to gold, really starting to outperform gold. So I love silver. You can, again, get leverage on top of silver's leverage by looking at junior silver mining companies. So I love that sector, and I think it's a great place to be.
I'm going to share my screen here real quick again. So this is the silver price, and it's been pretty exciting. I drew this heavy white line at 26, as if that will make it hold. But we just tapped 33 here. Shot above it for a hot minute, like a whale breaching the surface, and then came back down. What do you see here short term for silver? Do you see it trading in this range, or do you think we have a breakout coming?
Yeah, this is one of those tough ones because it's hard to divorce myself from the emotions of being so heavily invested in silver. There are signs that this breakout is for real, but if you notice those, and I'm sure you do notice those previous times where it's pierced above that $26 level
Yeah.
and come back down, notably that it could do so again. But you're also seeing a reverse head and shoulders pattern there that argues that this is a real breakout. And you will also see some wedges if you draw some lines that show this is a breakout. So I think this one is different than the ones before, primarily because we're seeing such a powerful breakout in gold. And investors who want to come in, and really traders that want to come into gold, are looking at the fact that silver is yet to move and figuring they can get much more torque by coming into that market.
Are you talking about like here in
Yeah,
inverse head and shoulders? Okay, yeah, and then we had the breakout.
yeah.
Okay, cool. All right. How about what are your thoughts on Mexico? We've got the new president coming in here soon.
Yeah.
She seems to be a little bit more business oriented than AMLO.
Little bit, not much.
Okay.
Yeah, it is scary for Mexico. It looks like they're trying to really consolidate power, and I'm not quite sure where that lies now, if they're going to have the votes to be able to do that before AMLO is officially out of office. But yeah, I'm really concerned about that. I do think that the mining industry, and as an industry and as an employer, and mining employees are so entrenched in Mexico that I think that will be a limit on what they can do. I hope it is, but yeah, it's scary. I I think that there are better regimes to focus on um, right now, but there are a lot of great projects in Mexico, and I think they are already pricing in this the political situation. So, you know, the risk discounts have already been applied, and so there are values. And if it means you buy something that's really going to be worth a lot in 5 or 6 years, a lot more than what it's worth right now, and you can kind of ride the election cycle. The next couple of years may be a little bumpy, but I think that they're going to come out on the other side, and the real values are going to be realized eventually.
Okay. Yeah, it's tough to invest in silver without going to Mexico. So,
Really is, really is.
yeah, got some spots in Peru, but that's about it. Okay, let's get your macro outlook for copper.
Yeah, I think I love copper for entirely different reasons than the precious metals. And it's really interesting to me that we are in a situation where we have two of the most powerful fundamental stories for metals that I have ever seen, but two entirely different stories. One for the monetary metals, gold and silver, and the other for the battery or energy metals. And I think that copper beats everything else because it's not easy to design your way or around copper. The technology just isn't there, and probably never will be, to replace copper windings, to replace copper as the method of delivering power through the grid. And the base case for copper, even if you throw away all of the electrification of transportation and all of that, if you throw all of that away and just look at the base case, current case for copper, you're still going into a very significant supply deficit, growing demand, and really constrained supplies, because it takes 15 years to 20 years to develop a copper project from scratch. And even the ones that are discovered are still, 8 to 10 years away from providing any supply to the market. So you're already in a great position for copper. Then when you start adding in even just a fraction of that electrification story, a fraction of the AI story, the data center story now, then you get what may be the steepest demand curve for any commodity in recent history, assuredly, but maybe in history at all. And there's just not enough copper out there to address the demand curve that's coming up ahead. Every major copper resource that's known today will have to be developed will need to be developed to even approach addressing that demand curve. And of course, not all of them will for political reasons, environmental reasons, et cetera. And again, if you find new deposits, it's going to take 2 decades. So I see a much higher copper price over the next 5 years. I think it's going to double over the next 5 years, if not more. And there's some great copper plays out there in the junior mining sector. And I think they're great long-term buys. They're not trades. They're set it and forget it investments. Find a section of your portfolio, buy these plays, say I'm gonna check back in a few years and see where they are.
Okay, okay. Basically, what you're saying is we haven't figured out a way to transport electrons cheaper than copper right now, and
No,
we're not going to use silver. We're not going to use anything else.
not gonna
Even
use
if copper
silver.
triples from here, it's still the cheapest.
Yeah, you're not
So,
gonna use aluminum. There's no way to get around copper.
yeah. Okay. Okay. And you're kind of taking the mindset of rather than trying to catch a moment in time when it goes cheap, if you just get in and
Yeah.
ride this out for the next half a decade or so, you'll be quite happy.
You will, because and there will be setbacks whenever there looks to be a slowdown in China. Copper price is going to reflect it. But over the longer term, over the next few years, we're going to see a dramatic response in the copper price.
Okay. Do you see any, a baseline floor, $4? Any thoughts on how low could this actually go before it just gets stupid?
Yeah, I think you're kind of looking at the baseline right there, wherever your line is. I can't really.
Okay.
Yeah. But I don't know that you want to wait. Again, if you're buying leveraged investments that are, some of these junior copper plays out there are at, 52-week lows already or near them. Just set some money aside and set it and forget it. I think that you'll do very well.
Okay. All right. Awesome. All righty. Audrey wants to know, does Brian invest in uranium stocks?
Yes, I do. Unfortunately, for 10 years running, said that uranium is going to be the big story of the next year. We said it every year, and in our mining share panel at the New Orleans conference, all of my fellow panelists said the same thing for about 10 years running. And the one year where I didn't say it, well, that's the one when it took off. It was just waiting for me. So I do have some uranium exposure in both our gold newsletter portfolio and personally, but not as much as I think we need to have. I think that the SMRs, the small modular reactors, is a big story that the market is just starting to appreciate. We saw the big news, of course, where Microsoft was restarting one of the 3 Mile Island reactors to support a massive new data center. These things are going to be popping up all over the place, and they need reliable baseload power. And that means not even connected to the grid that everyone else is connected to. So there will be small modular reactors employed over the next few years. Certainly by 2030, and I have seen some estimates that by 2027, 2028, we will have them on the ground powering AI data centers. That's going to have a significant effect on the already compelling supply-demand dynamic for uranium.
What do you see as far as the price level with it? We had the run up where it just overshot, and it got to $107 or $9 or something, and then we kind of flatlined for a while around 80. We've just started to tick up in the last week or so. Do you see 80 as a floor, or do you not really follow the physical market?
Well, 80 has been regarded as the kind of baseline price that's necessary to incentivize new production, because a lot of the production is cost at, 50, 60, $70 a pound. So you need a healthy margin. And so you really need uranium prices above around $80 to encourage the new supply to come on. The key over the short term is utilities and how they're acting in the spot market, how they're repricing long-term contracts. And I see a lot more power for uranium producers now than they ever had before, because they are, one of the darlings of the market right now. They're getting a lot of press, and they don't feel like they have to lock in lower prices and be at the mercy of the utilities. So there's a bit of a squeeze. We saw about a year ago, I guess it was, that when the price started to take off, we saw just a little bit of more urgency on the utilities in trying to secure supplies and reprice their contracts. Nothing really urgent, but just more of a sense of urgency. When that happens, when they really have to go in and bid against each other to get more supplies, that's when you're going to see that reaction in the uranium price. We hit $140 before Fukushima, way back when. I think that's where we're headed again, because the market, although it was a shot above equilibrium, as you said, I think that's kind of where the new equilibrium is going to set itself once we see these new sources of demand coming in. And, that's over the next 5 years. So it's a great story. I think it's a good buying level right now.
Okay. We do too. We're literally betting on it. All right. What is your
investing, not betting, investing.
Investing, yes.
Yes.
What is your macro outlook for oil and natural gas?
Yeah, I'm not an expert by any means on the sector. Obviously, oil is even more of an emotional market than gold, and pardon the pun, liquid. So it sloshes around the world, and it's much more attuned to geopolitical, although I think the markets have been somewhat inured by all of the geopolitics in the Middle East, and that's not having as much of an effect on the oil price. So I don't have a long-term outlook really, or short-term outlook on oil, although it does seem to be historically cheap right now. Natural gas, I think, has a bigger story for that same data center AI theme that I was just talking about. In the nearer term, that's going to put pressure on natural gas over the next few years, because that is what is going to power these AI data centers.
Yeah, you can build a natural gas power plant a lot faster than you can a nuclear one, and this could kind of fill that gap.
Yeah, absolutely.
Yeah. Okay. All right. Do you follow at all the restrictions on permits on us selling this to Europe and Asia at all?
Yeah, at a very high level, and that gets back into politics. So that's one area where we could see a big difference between the Democratic and Republican administrations. The permitting it's ridiculous that some of these, the LPG or LNG export facilities are essentially being halted right now, with no more permitting and some doubt about the permitting, which is enough to halt progress in projects all by itself. So I would see a Trump administration solving that issue, and I would not see a solution to the issue under a Harris administration. So that's one area I think politics really has a play in what happens.
Yeah, and the same thing in Canada if Trudeau gets reelected or not.
Yeah, absolutely.
Yeah. Okay, Lost Cause wants to know. He says, "What is Brian's opinion on more niche commodities that are extremely cheap right now, like vanadium, cobalt, and titanium?"
Well, lost cause is more like the title of the sector. I think it applies to the entire sector. Yeah, I think those commodities, there's a place for them. I think you need to have special situations to invest in them in the mining sector, where the valuations just get completely out of kilter. I'm looking at one thing in titanium in that regard, but generally speaking, you don't get a bull market in these sectors, in the mining stocks in these sectors. And of course, these are so niche that there aren't that many companies out there. but you need a fundamental underlying bull market in gold stocks and gold mining stocks before you have any hope of seeing a rising tide for all of these other sectors. You know, we saw the uranium mania around 2006, 2007, because gold was already in a bull market and pulling a lot of investors into the junior mining sector, and they began looking for other opportunities that were still overlooked. Same thing for the rare earth stocks back then. Same thing for lithium a few times over the last 10 years or so. So you'd need something. I mean, if we would have had an underlying gold mining stock bull market when we saw those little surges in lithium, well, God knows what would have happened. You know, you would have had lithium stocks popping up all over the place, even to a greater degree than we did see. So yeah, you need more interest in junior mining, I think, as a sector before you're going to get any of these little stocks or niche markets really moving. So
Yeah.
I would avoid them. I think the big story right now is gold, silver, and associated investments and the base metal energy stocks.
Okay. Okay. All righty. I did a deep dive into cobalt. Well, not a deep dive. I spent 2 days studying it, and I kind of found the same thing that it, Glencore pulls out 1 out of 4 pounds of cobalt,
Yeah.
but it's such a small percentage of their income. It could go away. It wouldn't affect them that much.
Yeah, and that's a story too for things like, or even silver, 70% of its production is as a byproduct, which is good and bad. You know, high prices won't bring more necessarily much more supply to market, but low prices, aren't going to constrain supplies either. So if it's a byproduct, it's kind of just steady state. This is what's going to get supplied to the market, generally speaking. And, cobalt's tough. If you look at battery chemistry, it can to some degree be designed around. And for most of the other components, if prices get high, then they find a solution that uses less of that particular commodity. Can't get around copper, though. Just
Yeah.
can't.
Yeah. Yeah. Kind of like they can do catalytic converters with platinum or palladium, depending on
Yeah.
which one's cheaper.
Yep.
Uh, okay, Matthew wants to know, what is the highest risk, both commodity and jurisdiction?
Yeah, I think we kind of touched on that. You know, Mexico's starting to scare me. There's worse places in the world. You know, the Congo is still not the best place to be, although they're starting to get copper out of there now, thanks to Robert Friedland. Um, yeah, if you're looking at PGMs, you've got the big U.S. project, and I'm blanking on the names right now.
Sibanye Stillwater?
Yeah, and they're cutting production and laying people off, and I believe they renamed themselves New Stillwater or whatever that's associated with it. Tremendous deposit, I think, has great long-term potential. But in the near term, I think the PGMs have become much more industrial metals than monetary metals. I think they've essentially lost their monetary allure, as it will. Although they're still considered precious metals, I think they're just higher priced industrial metals at this point.
Okay, all right.
And they don't really have a place so much in the battery chemistry market. And, so you don't have that underlying macro picture or macro theme driving that market.
Okay. And Derek wants to know, can you discuss your favorite London investment with the most potential for price appreciation?
I would think that he's talking about my long lost, far-flung cousins, the Lundins, or other than my personal portfolio. And if that's what he's talking about, I would say that Fireweed Metals is probably the highest potential one right now.
Okay, what do you like about Fireweed?
Well, it's a huge deposit and growing. And I think the Lundins are very interested in it, very excited about it, and aggressively growing it. which is why they took over the company on the cheap. So it is currently of such a size and grade that it is a strategic zinc deposit. They also have a tungsten deposit that nobody's really talking about right now. And I think that it has tremendous upside potential. It's still growing and is going to get much larger. And it's imminently developable by that group. So I think that has lots of upside potential. I am a shareholder, by the way.
Okay. There you go, Derek. Fireweed. And Sylvia wants to know, can Brian talk about his process of how he identifies opportunities and stays on top of developments? What media sources, what tools do you use?
Yeah, I think the key is spending close to 4 decades in the industry and talking to everybody. So that's number one, the thing you need to do. At this point in my career, if I don't know someone in the industry, I know their best friend. I've got my ear to the ground in every market. I've got my amateur spies for me in every aspect of the market. When a new play comes on, I usually hear about it early. And I'm not a thematic investor, although I've talked about a couple of big themes here and there. Um, I really take each opportunity on its face value and see if it presents an opportunity to my readers to make a lot of money in a relatively short amount of time. So I am talking to companies every day of the week. I'm going to all of the conferences out there, and I've got people texting me and emailing me about opportunities all the time. So it really is building a network. I think for the average retail investor in the sector, I think it's going to these conferences, subscribing to the best newsletters out there, spending a little time and money and in skull sweat researching who owns the companies, what previous successes have they had, et cetera, and just keep building that network. Probably a good time to mention that on our website at goldnewsletter.com, I have a free special report. It's not a sales piece. It's not a three-page flyer promoting anything. It is a 40-page report, The Investor's Guide to Gold and Silver, that covers everything from physical metals to mining stocks, futures, options, mutual funds, ETFs, everything that you could want, and it's free. So if you look on the homepage, there'll be a box. There it is, right to the left there.
Yep.
Yeah, click on that and you give us your first name and your email address. And you'll also get a subscription to Golden Opportunities, which includes my macro views on the market, my commentary a couple of times a week on what's happening in metals, mining, and the greater economy.
Awesome. We will put a link down in the pinned comment below. Brian, do you have any closing thoughts?
Yeah, Gold Newsletter it is by far the longest running metals and mining advisory out there. And I think it's the oldest continually published investment newsletter in the world today. I don't know of one older than that. We're in our 54th year. It was started in 1971, literally on the day that Nixon closed the gold window, by my mentor, Jim Blanchard, and eventual business partner, Jim Blanchard. He passed away in 1999, and I'm continuing his legacy of Gold Newsletter and the New Orleans Investment Conference ever since. So in Gold Newsletter, you get my commentary on the macro picture, what's going on in the metals, what's going on in the mining market, plus specific stock recommendations. So that's where we really serve up the dessert for the readers, and that's what you don't get from Golden Opportunities, are my specific stock recommendations. There's no paid coverage in Gold Newsletter. It's entirely merit-based. Our recommendations are purely companies that, with my many years of experience in the industry, I feel will have present a great opportunity to make an awful lot of money in a relatively short amount of time.
Awesome. Well, thank you very much, Brien. I'm really looking forward to the conference November 20th through 23rd in New Orleans. That's a fun town. I got to go
Yep.
there once, and I'm looking forward to going back and meeting you and all the presenters in person and doing as many interviews as humanly possible. So thank you, sir.
Thank you, Steve. Thanks for the opportunity.
Yes, thank you. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.